Somewhere in a downloads folder, or a drawer if you're old school, there's a quarterly statement with your name on it. Retirement account, or your parents', doesn't matter which. Scroll past the summary page, past the pie chart, down to the fine print, and one line reads something like, fixed income, investment grade. That line is built to be boring. It's not supposed to keep anyone up at night. But underneath, it isn't cash sitting in a vault. It's a loan. Money handed to a company you've never heard of, arranged by a fund you've never heard of, sitting 3 or 4 steps outside anything you could actually see from where you're standing. An annuity, legally, isn't really an investment. It's a promise. Insurance regulators require the company backing it to hold assets safe enough to guarantee a check every month for the rest of your life, regardless of what markets are doing. For most of the last century, that meant government bonds and highly rated corporate debt. Dull, liquid, priced daily by thousands of buyers and sellers who'd flag a problem within hours if one showed up. That mix has been changing fast. In 2025 alone, the private credit held by U.S. life insurers grew more than 20%, pushing it to roughly a tenth of everything they hold. Private credit means loans made directly to companies, held inside a fund instead of traded on any public exchange. No daily price, no independent rating agency checking the math. Often, the same firm that made the loan is the one deciding what it's worth on paper. One insurer doing this would be a footnote. It isn't one insurer. By the end of 2025, illiquid private debt held by U.S. life insurers had reached $807 billion, up $122 billion in a single year. The 10 largest insurers alone account for $352 billion of that, nearly half the industry's total. And at insurers owned outright by private equity firms, the share isn't a tenth of assets anymore. It's closer to 1/6. The statement sitting in that downloads folder isn't the exception here. It's close to the median. Picture the path a dollar like that one takes as plumbing, because that's closer to the truth than a chart. At one end, a company needs a large loan fast. Increasingly, in the last few years, that company is building the physical backbone of artificial intelligence, server farms, data centers, long-term power contracts. Public banks are cautious about lending against that kind of collateral on that kind of timeline, so the company turns to a private credit fund instead, willing to lend quickly at a higher rate and stay out of public view while doing it. That fund needs its own capital to lend with. A meaningful share of it comes from insurance companies, buying into the fund, lending to it directly, sometimes both at once. The fund passes the money to the data center builder. The builder spends it, and the insurer books the fund's loan as a safe, income-producing asset, the exact bucket backing the statement this started with. Follow a dollar like that one end to end, and it begins as a promise to build a server farm and finishes as the investment grade line on a retirement account, without a single name in between that a policyholder would recognize. It happened because it pays better. Private credit yields more than a public bond carrying similar risk, and for an insurer competing to offer the highest guaranteed rate on a new annuity, that spread is the difference between winning the sale and losing it to the carrier down the street. There's a second reason, and it matters more than the first. Athene, one of the largest annuity sellers in the country, is owned by Apollo, a firm that also originates the private credit loans Athene buys. Global Atlantic runs the same setup under KKR. The parent company collects a fee for managing the fund. The insurer collects a return for lending into it. Both ends of that trade sit inside one organization, meaning the entity deciding how much risk to take and the entity profiting from that risk being taken are, increasingly, the same entity. That's a workable arrangement as long as the loans get paid back. Through the first half of 2026, a growing share of them haven't. Morgan Stanley put the default rate on private direct lending at 5.6%, heading toward 8%, with the pressure concentrated in software companies whose revenue is getting eaten by the same AI boom the industry is financing. Blackstone's BCRED, the largest private credit fund in the country at roughly $82 billion, hit its limit that same quarter. Investors asked to pull out 7.9% of their shares, well past the 5% Blackstone had built the fund to handle in any 3-month stretch. For a hedge fund, that's an uncomfortable quarter. For an insurer, it runs straight into the promise sitting behind your account. Because the number on the statement assumes those loans can be sold or repaid at roughly the value the insurer itself wrote down. Because these loans don't trade on any public market, nobody outside the insurer is required to check that number in real time. Researchers inside the Federal Reserve had already mapped how tangled these arrangements were getting back in 2025. What hadn't happened yet was anyone with the authority to act on it. That changed on May 7th, 2026, when Treasury Secretary Scott Bessent sat down with state insurance commissioners and the industry's own regulatory body to talk, for the first time at that level, about exactly this. Go back to the line on the statement. Fixed income, investment grade. It still says exactly what it said at the start of this. The word on the statement hasn't changed. What's sitting behind it has.